Hello and welcome to the 2018 second quarter investment call with the San Diego Foundation. I'm Brian Zambano, Vice President of Development and Stewardship. Thank you for joining us today. These quarterly investment calls are an enhanced service to our donors and provide direct access to our investment leaders in a consistent, convenient, concise format so donors can remain informed about the performance of their charitable assets. Leading today's discussion will be Steve Klosterman and Matt Fettig. Steve Klosterman is Regional Director at Halbert Hargrove and serves as Investment Chair for the San Diego Foundation Board of Governors. Steve advises a wide range of individual and institutional clients and began his investment management career more than 35 years ago, building his own registered investment advisory business. Steve is immediate past chair of the UCLA Foundation and a founding board member of the UCLA Investment Company, which oversees a $2 billion endowment. As Chief Investment Officer of the San Diego Foundation, Matt Fettig oversees and manages our investment strategies and activities. This includes working with the Board Investment Committee, senior staff, auditors, professional volunteers, fund managers, and outside consultants to establish, maintain, administer, and monitor policies related to foundation investments. Today, Steve and Matt will start the call with a brief macroeconomic update, followed by performance and attribution reports for our endowment portfolio and our long-term, medium-term, and short-term portfolios. We will conclude with a question and answer session. To submit questions, please use the questions chat function located on the webinar sidebar menu anytime throughout the call. Any questions unanswered during today's call will be answered via email. Attendees can access slides and a recording of today's call on our website at sdfoundation.org by tomorrow. Now, Steve Klosterman will get us started.
Thank you, everyone, for being on the call. Thank you, Brian. As you've heard from us before, we are value-driven investors, and we take a long-term approach to investing your charitable dollars. I mean, basically, our time frame is theoretically infinity. This exhibit that you're seeing here provides a snapshot of stock valuations across various geographies. The geographies you see, EFI, that's the developed international markets, so all your major Western European countries, Japan, Australia, etc. Then obviously the US and then emerging market countries. In every one of those metrics, you'll see better valuations based on these metrics compared to the United States. I'd also like to add a couple of things to that. If you look, which we will address a little later, growth rates, these markets, particularly emerging markets, are very, very attractive relative to how cheap they are and relative to the growth prospects for those countries. Another way to look at it, to put it in some context, is it's very dangerous to be overly US-centric. We are only 24% of the world economy. So there's a lot going on outside of the US. In terms of the stock market, because we're an old capitalistic society, we are a very significant portion of the world stock market. We're about 54% of the world stock market. But again, so almost half of world stock market valuations are outside the US. The final point I'll make in that regard, if we include the bond market, so we're now looking at stock and bond market, the US is about 36% of the world. So it's a global world, we're global investors, and again, we have a strong valuation orientation. And these markets look very attractive based on those valuation metrics. And maybe also, as importantly, they look attractive, at least on one measure, price to book, relative to their 25-year average. So their price to book ratios are lower than their 25-year average. Let's go to the next slide. The next slide has to do with the US dollar and trade weighted index. Basically, when you invest internationally, there's two ways you earn returns. You earn returns in the local market, in that local currency. And that can be positive or negative. And then also, you can, if you don't hedge, which we generally do not do, you can earn a return from the currency. So if the dollar is weak the way it was last year, we earned dual returns. We made money internationally in our local currency investments, and then when we converted back to dollars, we made even more money because the dollar was weak in aggregate relative to those currencies. And last year, I'll point out, your best performing area of the market was emerging markets. This year, that's not been the case, and one of the main reasons is, again, the dollar has now strengthened relative to those currencies. But just remember that, again, when you invest internationally, you have both the local return, but also a return related to currency, and that return can be negative or positive, depending on the strength of the dollar. Let's go to the next slide. In the last call, I was asked to comment on tariffs, and I made a very brief, simple statement, which is tariffs are really a form of a tax. So they're a tax that either the company is going to pay, or depending on the business, if they can pass it on to their consumer, the user of their goods or services, they'll pass that on. So right now, to put it in some context, in terms of goods, not services, in terms of goods, the U.S. exports are only about 8% of our economy, of our GDP. But we have significant exports of services, and that's not monitored, and a lot of people haven't factored that in. One of my big worries is if countries start to decide to try and tax services, so legal, accounting, consulting, etc., and we end up in a really big tariff war that could be very detrimental. Right now, it's fairly benign, but if I have two big worries in the marketplace right now, it's tariffs and it's the Fed. And if the Fed raises rates too fast, we could have problems in our stock market and our economy in general. So suffice it to say, keep your eye on tariffs. We certainly are, and there will be winners and losers. And one of the jobs of our money managers is to figure out who the winners and losers are going to be, and that's one of the things we talk to them about. Let's go on to the next slide. Okay, this shows back to GDP growth expectations. So again, economic growth expectations. You can see emerging markets right at the top. It shows 2018 in blue and the 2019 forecast, and then you see it compared to some other countries in the Eurozone. Suffice it to say, these are the fastest growing economies in the world. They have tremendous, enormous, emerging middle classes. And one of the big plays and investments, if you will, is to invest in companies that offer basic consumer staple products because of these growing middle classes. But there will be hiccups, there'll be ups and downs, and you have to take a long-term view. And again, we address the potential impact in currency. I will tell you in my other institutional involvements, one was mentioned, I'm a director for the UCLA Investment Company. I'm also on the American Lung Association Investment Committee for their national group. And in both cases, we have tilts to international, specifically to emerging markets. Now notice I use the word tilt. It's not some heavy reallocation. It's a tilt, and it's driven, again, by the point I made about attractive valuations, both currently relative to other markets, but also relative to their own history and these tremendous growth prospects. So with that, I'll turn it over to you, Matt.
Thanks, Steve. Thank you for your comments. I will now dive into the performance and attribution section. As you can see here on the exhibit in front of you, we'll start with the endowment portfolio. So for the second quarter, the endowment portfolio, it was really a difficult quarter driven by a few different factors. Steve was kind enough to explain why we have a fairly significant weight to both non-U.S. developed stocks and emerging markets. It just so happened during the second quarter that the U.S. dollar appreciated rather significantly, as you saw in the slide. And a few country-specific issues Italy, Turkey, led to some underperformance in the non-U.S. stock section of our portfolio. So I think if there was any factor driving our underperformance for the quarter, it was really the fact that the dollar appreciated and we had some underperformance from that non-U.S. section of our portfolio. I will say overall, we are value investors, and value investing has been out of favor for a significant period of time. That was really exacerbated even further during the second quarter. And really any investment manager that's trying to buy cheap assets has underperformed, and we do have quite a few of those in our portfolio. The other cause of the underperformance for both the quarter and the one-year period for the endowment is our private equity or private capital portfolio. We have about a 6% allocation to that area. It's 6% of the alternative sleeve you see in the pie chart. And what we're trying to do over the long term with this portfolio is build a portfolio that can outperform the U.S. stock market by 3 to 5%. And that is a long-term goal. However, as you're building that portfolio, and we are still in the building phase, it's quite often to experience what we call the J-curve effect. And without getting too technical, the idea is that as a private equity manager makes an investment in a private company, it can take years for them to create value within that company. There are a number of levers they have to pull, but they often hold those early companies that they purchase at cost. Meanwhile, us, the investor, are paying fees to the private equity manager. And so what often happens in the early years is as these companies are held at costs and we're charged fees, we show a loss in the early years. Over the course of 3, 5, 7 years, as the portfolio companies that they've purchased appreciate and are marked up or sold at a premium, then we start to really see the benefits of private equity. Now, the great thing about the endowment is it is permanent capital. So all of you will participate, all you endowment fund holders will eventually participate in the upside of this private equity portfolio over the years to come. So let's move on to the long-term portfolio. Again, similar to the endowment, but without the illiquid assets like private equity and real estate. Really, two things. We've already talked about one of them, but we have just as much in non-U.S. stocks and emerging market stocks as we do in the U.S. And while the U.S. outperformed for the quarter, non-U.S. stocks underperformed, and that was one of the factors that hurt us. The second factor was really within the alternatives bucket. We had one manager in particular, and they're a quantitative-oriented manager, and they rely very heavily on what they call the value factor, trying to buy stocks that are cheap. And as we've talked about, that factor was very out of favor during the quarter. It's been very out of favor so far this calendar year-to-date period and resulted in some of the underperformance that we've seen in this portfolio. The medium-term portfolio in line with this benchmark for the quarter, but on a calendar year-to-date basis, slightly negative. Remember, if you look back to the first quarter of this year, the stock market appreciated pretty rapidly in January, followed by a fairly sharp correction in February, and a pretty sharp move higher in interest rates at that time. This is a more conservative portfolio, and by conservative, I mean it has a much higher allocation to bonds or fixed income. And it really did get hurt there in the first quarter as interest rates moved higher. That said, this quarter in line with its index and outperforming its index over a one-year period. You know, we've had a lot of volatility here since February, and I want to give you a sense. We are long-term investors, but we are sometimes making changes in the portfolio where we feel it's appropriate. And I want to talk about one of those changes we made during the second quarter. Our bond portfolios over the last several years have been highly diversified. They've been diversified across areas like high yield bonds, emerging market bonds, non-US bonds, and we really benefited over the last couple of years from the very strong performance in those areas. However, some of those areas have a higher correlation to the stock market. And as they've appreciated in value over the course of many years, we've recognized that the upside left in those bonds is fairly minimal compared to the risk and downside. And as a result, we lightened up significantly during the quarter in areas like high yield, non-US, and emerging market bonds. And just to give you a sense, in the endowment and the long-term portfolio, we significantly lightened up on emerging markets debt on April 1st. Throughout the second quarter, that area of the portfolio was down about 13%. So despite the performance numbers you see here in front of you, we are making changes to the portfolio, and we have done some things to mitigate losses in the portfolio. So finally, let's talk about the short-term portfolio. I think as most of you know, this portfolio is invested solely in money market funds. Money market funds yields are very highly correlated to short-term interest rates. Short-term interest rates are dictated in the U.S. by the Federal Reserve. And for a long period of time, as short-term interest rates were near zero or at zero, this portfolio was generating essentially no yield. As the Federal Reserve has continued to increase interest rates here over the last several quarters, the yield on this portfolio has continued to appreciate, as you see in front of you. So future interest rate hikes would add to the yield in this portfolio. Interest rate cuts, meanwhile, would detract from the yield of this portfolio. So with that, I'm going to turn it back over to Brian.
Thank you, Matt. Thank you, Steve. Now, we'd like to take your questions. As a reminder, to submit questions for the Q&A, please use the questions chat function in the menu bar.
As an update, we had a few questions in regards to our CEO search. So while you're thinking of your questions and getting ready to submit those, the Board of Governors is finalizing the CEO search process. And in fact, we have a meeting after this, the executive committee, followed by a special board meeting. Our board chair, Constance Carroll, is leading the effort. An announcement will be made in the coming weeks regarding the process and how potential candidates can apply. Immediate past chair, Connie Matsui, is serving as our interim CEO, and she's doing an outstanding job. She has significant business experience, been a very active volunteer, and she is a Stanford MBA. Our goal is to deliver the same high level of service and quality reporting to you during the transition. I don't expect anything other than the same high level you've been receiving. In fact, I'll commit to that. And we are deeply committed to the mission of the San Diego Foundation, including maximizing the impact of your charitable giving throughout San Diego region. Thank you.
So our first question is, how has the situation in Turkey affected the portfolios?
I'll take that one. So the answer is it's had a little bit of effect in emerging markets. Oftentimes when one emerging markets country falters, it can spread across other emerging markets. Emerging markets tend to be a risky asset class. And so in the short term, it can have a broader impact, but over the medium to long term, you've really got to ask, is Turkey really a systemic risk to the system? Who owns Turkish debt? Will Turkey be able to pay back that debt? And so for those of you that don't know, Turkey over the course of the last several years and really more recently, so far this year to date, has engaged in some economic policy that hasn't made a great deal of sense. And as a result, their currency had depreciated fairly rapidly over the last couple weeks, and there was some concern about that. Turkey is really not a systemic risk to the system. And I think it will go down as more of a probably short-term blip, had some effect on emerging markets as a whole, but over the long term, unlikely to have as great of an effect.
Yeah, you can be assured it's a minuscule percentage in your portfolio if there's any direct exposure at all. It's more the contagion effect that Matt referenced, which is people reacting to Turkey and having it spread through the emerging markets, concerns about those other countries. But we run highly diversified portfolios, and Turkey's just not a major economic player, so we're not going to have any or minimal exposure there.
Thank you, Steve. Thank you, Matt. Our next question is, how is the foundation taking steps to protect capital should the market roll over?
Sure. So, as Steve just mentioned, we build highly diversified portfolios. A lot of times we do get questions relative to how our portfolio did to the S&P 500. And I often have to take a step back and remember that not everybody understands how diversified our portfolios are. So the S&P 500 represents U.S. stock exposure, but depending on what portfolio you're talking about, that's only a portion of what we invest in. So we do invest in a few different areas of the portfolio that provide us some protection in the event of a market rollover. Bonds provide a fairly negative correlation to stock markets, particularly treasuries, U.S. treasuries, as there is often a flight to safety during periods when markets roll over. As I mentioned with our bond portfolios, we had those fairly highly diversified in the more equity-like areas, and we have reined that in so that we feel we will get more protection from our bond portfolios if that were to occur. Another factor is we do have some alternative investments in the portfolio that do not correlate highly with either the stock market or the bond market. And the reason we have those into the portfolio is to provide us some protection in the event that markets do roll over.
Yeah, I want to add to that, Matt, and reinforce something that you said and I've said on the call. We're long-term investors. Matt reviewed for you your 10-year returns. Now, remember, the 10-year returns include 2008. You have to go back pre-World War II and all the way back to the Great Depression years to see a year that horrible in the S&P 500. And yet, in spite of that and absorbing that year, our 10-year returns, long-term portfolio, 5.5% annualized, and on the endowment portfolio, 5.9%. So hopefully that gives you some comfort that diversification does work over time, and you can absorb a really, really bad year when you're diversified and you take a long-term view. To also put that in context, that the CPI over the last 10 years has only been 1.53%. So our returns are even better when you look at it compared to inflation. And then they're even really, really better when you look at it compared to cash. The 3-month T-bill annualized return for 10 years was 31 basis points, so it was less than 1/3 of 1% per year over a 10-year period. So we've done very well relative to inflation and relative to cash when you take a long-term view and absorbing, again, a horrific 2008.
Thank you, Steve. Thank you, Matt. And thank you, everyone, for joining us today and for partnering with the San Diego Foundation to maximize the impact of your charitable giving. Today's presentation will be available by end of day tomorrow on our website at sdfoundation.org/investments. Thanks again and have a wonderful day.